Imagine opening your mailbox and seeing a letter that doesn't just change your month, it changes your entire life. A missed payment notice, a layoff letter, a health insurance cancellation. And the scary part is, you didn't do one big wrong thing. The economy around you simply cracked. Today, we're going to walk through how the 2007-2009 financial crisis and the Great Recession that followed hit everyday families in ways you could feel at the kitchen table, not just on Wall Street. In the next 13 to 15 minutes, you'll learn what actually happened in plain English, the most important data points researchers agree on, and the real-world ripple effects on housing, jobs, family finances, health, and kids' education, plus practical, safe steps you can take to be more resilient in any downturn. Informational only, no hype, no promises. Let's start with a fast, clear overview, because the crisis can sound complicated, but the family-level effects are easy to understand once you see the chain reaction. At the center was housing. For years, home prices climbed quickly, and mortgages became easier to get, including loans, with features that looked affordable at first but could become expensive later. Those mortgages didn't just stay with the local bank. They were bundled, sold, and spread throughout the financial system. When homeowners began falling behind and home prices stopped rising, that whole machine started to fail. Then, in 2008, the stress in the system turned into a panic. Major financial institutions faced huge losses, credit tightened, and businesses and consumers pulled back. The U.S. entered what's commonly called the Great Recession. The official recession dates were December 2007 to June 2009. And here's the key. When credit and confidence collapse, it doesn't stay in trading rooms. It spreads to hiring decisions, rent checks, grocery budgets, and whether a family can stay in their home. By late 2009, the unemployment rate was extremely high, reaching 10.2% in October 2009, according to the U.S. Bureau of Labor Statistics. That number isn't just a statistic. It represents millions of people who wanted to work and couldn't find it, and many more who were scared they'd be next. Now let's talk about what this meant for families step by step. For many families, the most visible impact was housing instability. In 2009 alone, RealtyTrac reported foreclosure filings on over 2.8 million U.S. properties. That's a massive disruption, not just for homeowners, but for neighbors, renters in foreclosed buildings, and entire communities dealing with vacancies and falling property values. Even if you didn't lose your home, you might have felt the secondary effects. Neighborhoods with more vacant homes, local small businesses losing customers, families moving away, kids switching schools, and a constant background fear. If one paycheck disappears, what happens to us? And housing is emotional. A home is where your kids measure their height on the wall. It's where you host holidays. When a foreclosure happens, it's not just a financial event, it's a loss of place and stability. The crisis also hit paychecks hard. The Bureau of Labor Statistics documented that total non-farm employment fell by 8.7 million between the employment peak and trough during the Great Recession. This wasn't just some layoffs. It was a labor market collapse that touched construction, manufacturing, retail, and many local service jobs tied to consumer spending. And when a job disappears, the impact spreads. Rent or mortgage gets riskier, car payments become a threat, childcare becomes complicated, and one unexpected bill can turn into a crisis. Even families who stayed employed often experienced reduced hours, frozen wages, or fewer opportunities to change jobs. That's important because resilience isn't just about employment status, it's also about how stable and predictable income is. When people hear financial crisis, they sometimes imagine it mainly affected investors. But the crisis destroyed household wealth through two everyday channels: home values and retirement accounts. Research summarized by the Federal Reserve Bank of St. Louis notes that household wealth declined almost $17 trillion in inflation-adjusted terms, about a 26% drop from mid-2007 to early 2009. Here's why that mattered for families. For many households, a home is the biggest asset they own. Retirement savings often sit in markets that fell sharply. When asset values fall and debt stays the same, families can feel trapped, like they're working hard but moving backward. And it hit unevenly. Families with fewer resources to begin with often had less cushion and less flexibility, meaning the same economic shock could cause much deeper damage. When budgets get squeezed, families don't just cut back, they make painful trade-offs. The U.S. Census Bureau reported the official poverty rate was 15.1% in 2010, and the number of people in poverty was 46.2 million. And one of the clearest signs of strain is food insecurity, when households don't have reliable access to enough food for an active, healthy life. USDA's Economic Research Service reported that the number of food-insecure households rose from 13 million in 2007 to 17.1 million in 2008. That's not abstract. That can look like adults skipping meals so kids can eat, cheaper, less nutritious food becoming the default, and anxiety every time the pantry runs low. Economic shocks don't stay in your bank account, they show up in your body and your mind. A peer-reviewed study in psychological medicine found that exposure to foreclosure was associated with increases in symptoms of major depression and generalized anxiety disorder in a community sample, even after accounting for other factors. And a broader systematic review concluded that most studies it identified found foreclosure had adverse effects on health or mental health outcomes. That matters because financial stress can create a loop. Stress leads to sleep problems, which leads to worse decision-making, which leads to relationship strain, which leads to less ability to job search effectively, which leads to more stress. If you lived through that period, or your parents did, you may recognize the emotional tone of it: uncertainty, shame, fear, and the feeling that the rules change mid-game. When families move abruptly, children carry the disruption. Research on children in the foreclosure crisis has documented that foreclosure can be linked to increased mobility and instability that affects students' lives and schooling. Even without turning your kid's life into a statistic, the mechanism is straightforward. Changing homes often means changing routines, sometimes changing schools, and always changing a child's sense of security. On the public system side, school budgets also came under pressure after the recession. A long-term analysis from the Education Law Center describes the lost decade of school funding effort after the Great Recession, estimating that students across the U.S. lost nearly $600 billion due to state disinvestment in public schools over 2008-2018. To be clear, outcomes vary by state and district, but the broad point holds: when a recession hits, families and the institutions they rely on can feel it at the same time. Here are two composite stories based on real reporting. Maria and Daniel bought a modest home when their first child was a toddler. The payment looked manageable at first, but when work slowed, overtime disappeared, and a reset in the mortgage terms pushed the monthly bill higher. They tried everything: cutting cable, selling a second car, calling the lender again and again. The hardest part wasn't one dramatic moment. It was the slow goodbye, packing a little at a time, avoiding neighbors out of embarrassment, and trying to keep bedtime routines normal while the adults whispered about money after the kids fell asleep. When they finally moved, their child asked if they could visit the house like you'd visit a relative. The loss wasn't just financial, it was identity, community, and a sense of safety. Kevin worked for years at a company he thought was stable. Then one morning, the manager's voice sounded different, and the meeting was shorter than usual. He drove home with a cardboard box in the passenger seat and rehearsed how to tell his partner without scaring the kids. At first, he treated the job search like a full-time job, but as weeks turned into months, the stress leaked into everything. He slept lightly, snapped over small things, and started avoiding friends because he didn't want to answer. "So how's work?" The bills didn't stop, and neither did the feeling of falling behind. Eventually, a counselor helped him name what he was carrying: not just money fear, but grief and shame. That didn't fix the economy, but it helped him breathe again. A crisis like this doesn't end the day markets calm down. Its effects can stretch for years. One long-term consequence was how long it took the job market to fully recover. Analysis notes that after the employment drop, it took a historically long time for employment to recover to its prior peak. Another consequence: financial habits changed. Many families became more cautious about taking on debt, more skeptical of too-good-to-be-true offers, and more aware that emergencies aren't rare, they're part of life. And there are institutional lessons too. Transparency matters. Families should be able to understand the risks in financial products. Consumer protections matter, because complexity often lands hardest on people with the least spare time and margin. Safety nets matter, because layoffs and health shocks can happen even when you've done everything responsibly. Most importantly, this crisis taught a human lesson. When systems break, it's ordinary households who absorb the shock through disrupted childhoods, delayed milestones, strained relationships, and lost years of stability. Now let's end with steps that are practical and safe, and that don't rely on hype or unrealistic promises. First, a policy line I want to say clearly: this video follows YouTube's spam, deceptive practices, and scams policy. No misleading claims, no guarantees, and no impersonation. Here are grounded actions that can help in any downturn. Build breathing room, not perfection. If you can, aim for a small emergency buffer. Even a modest cushion can reduce panic and give you time to make better decisions. Start tiny and consistent, a fixed amount per paycheck when possible. No shame if it's slow. If you're struggling, contact help early. Housing problems get harder the longer they sit. If you're facing missed payments or eviction risk, reach out early to reputable local resources, nonprofit housing counselors, legal aid, or community action agencies. Earlier conversations often create more options. Protect the basics first. In a crisis, prioritize essentials: housing, utilities, food, transportation to work, and necessary health needs. If you're making trade-offs, you're not bad at money. You're adapting under pressure. Use job support systems without shame. If you lose work, apply promptly for unemployment benefits if eligible, look for workforce development or job training programs, and consider community college or local upskilling resources. The point isn't to reinvent yourself overnight, it's to widen your options. Take mental health seriously. It's part of recovery. Financial stress can trigger anxiety and depression. If you notice constant dread, sleep issues, or withdrawal, consider talking to a licensed professional or a trusted community support resource. Getting support isn't weakness, it's maintenance. Talk as a family in age-appropriate ways. For kids, uncertainty can be worse than the truth. You don't have to share every detail, but you can reassure them, adults are working on it. You are safe. We're making a plan. Quick disclaimer. This video is for general educational and informational purposes only. It isn't financial, investment, or legal advice, and it can't account for your personal situation. If you need personalized guidance, consider speaking with qualified professionals or reputable local assistance organizations. If this helped you understand what families really went through beyond the headlines, please like the video and subscribe. And if you're comfortable, you can share in the comments how the crisis affected you or your family. No pressure, and please protect your privacy. Also, tell me what follow-up you want next, how families recovered, what changed in lending and regulation, or how to recognize risky financial offers before they spread.